A few years ago, I had to completely rethink my retirement strategy as a practicing dentist. Why? Well, a wrist injury while I was snow skiing was my big wake up call, as in my line of work, if I can't use these, then no money's coming through the door. At that time, I was on the path to accumulation via the 401k method. Now, this wake up call really made me realize that I was actually operating our finances on a hope and prayer that I'd be able to use my hands to dig around in people's mouths for the next 30 years. Nasty, right? I'm all about mitigating risk whenever I can, but up until this point, I had only one income source, that was my active income, and I had invested over 99% of my money in the stock market with mutual funds. What about you? What does your retirement strategy look like? Now, if you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race with passive income. Go ahead and download the passive income guide I've put together for you below the video. Now, after this wrist injury, it didn't take long researching out there to understand why the wealthy are so rich. Number one, over 90% of millionaires have some sort of real estate in their portfolio. At that time, I only had my home that nobody's paying me rent. Number two, most of the millionaires, they average 3 to 7 income streams. Back then, I only had one income stream, and the only real estate, again, that I owned was my home. Not good. Now, I decided to take my finances a lot more seriously, and I began to focus on developing extra income streams from real estate. But like most people, I didn't have a clue where to start. Now, with sky high inflation and the stock market all over the place, I can't think of a better time to discuss the 10 ways that you can invest in real estate for retirement. Let's begin. Number one, you're probably familiar with these REITs or real estate investment trusts. Now, these can either be private or public. Now, when you're investing in these, you're actually buying stock in a company that owns, operates, or finances income producing real estate. Now, the publicly traded shares of REITs can be purchased on pretty much any major stock exchange, whereas the private ones are only available to accredited investors. A couple examples of REITs are apartments, self storage, hotels, office buildings, and retail centers. Number two, turnkey real estate rentals. An easy way to start passively investing is by these turnkey rentals. This is actually becoming one of the more popular buy and hold strategies, as you can get started using companies that actually go out, they seek and they find undervalued property in strong rental markets. Their goal is to then renovate these properties and then sell them as, quote, move in ready for you and me, the passive investor. This actually removes the investors from actually having to oversee this entire painstaking renovation process. Most of these turnkey real estate companies provide other services such as maintenance, management, and they do all the marketing to make sure that there's a tenant paying you income. Typically, investors can realize a cash return the day a property closes because they're managed professionally. On the downside, there is a potential for a short term negative cash flow while the property is actually being turned over from one tenant to the next. Number three, fix and flip. Now, a fix and flip is basically the process where you go in and you rehab a distressed property, you fix it up, and then you just simply flip it to sell it. Now, as a busy professional myself, I stay away from any type of active real estate investing. Instead, I invest 100% in passive deals. More about that a little bit later. But there are some people out there that just get really excited about finding great deals that they know can be made profitable with a little bit of TLC. By finding lower price deals, your investment will typically cover the down payment, which is usually 20% of the purchase price, along with some of the repair costs and closing costs. An easy way these people that flip houses can actually determine the maximum price that they should pay for a rental property to turn a profit is by using something called the 70% rule. So this rule states that basically an investor should pay 70% of the ARV, the after repair value. So an investor should pay 70% of the after repair value of a property minus the cost of the repairs and improvements. All right, moving on to number 4, crowdfunding. Now, the Jobs Act of 2012 actually opened the door for many small businesses, including real estate companies, to raise money through public crowdfunding. Private equity real estate investing, it actually used to belong solely to the super rich, the elite, the well connected. But crowdfunding has now allowed the average investor, you and me, to participate in real estate in a way that was before next to impossible. Online crowdfunding platforms are for those who want to join others in investing in a bigger commercial or residential deal. So with these investments, fund managers actually go in and they pool your money to buy property. So the profits that are actually made from renovating, operating, and eventually selling the real estate, these profits, they get divided up among the investors. There's actually usually two pieces with this type of investing: a dividend, which is paid out quarterly or annually from the operating cash flow, and then the actual equity growth, which is from the appreciation, which is actually reflected in the share price. Now, there are hundreds of real estate crowdfunding platforms out there, and I got my start passively investing in a handful of these. Now, I also lost $50,000 early on in a deal where, looking back, I had no business really investing in the first place. This failure allowed me to actually take a step back, understand what my mistakes were, and then move forward armed with the education that I need to mitigate risk while investing. Now, as a side note, as you can imagine, I no longer invest with these types of platforms. I now only invest in deals where I can actually personally meet the sponsors of each project and tour the properties with them, because I want to mitigate not only my risk, but risk for other people that invest alongside of me. Number 5, hard money lending. Now, if you have excess cash in hand, then you can actually do something called you can actually become the bank, and you can lend money to people like these house flippers or landlords who actually need to do serious work to a property before they can get just a typical bank loan. So a hard money loan is generally, these are generally a short-term loan, which is usually a year or less, that's issued on a property during the rehab phase. For example, a friend of mine loaned money to an investor who bought a house intending to complete a renovation and then reselling the property. Because he loaned him this money, he earned 12% interest plus 2 points. Now, point is an upfront fee of 1% of the value of the loan. So he earned 12% interest plus 2 points. Not bad. He loaned a total of 75% of that after repaired value, and the real estate itself, it actually secured the loan. Now, by using conservative numbers and using the physical real estate as collateral, you actually go in and you can reduce your risk. Number 6, you can actually go and become what's called a money partner. Many people wanting to start investing in real estate out there, there's a lot of them, but they have little to no money to do it themselves. So even if a bank loans you up to 80% of the deal, sometimes coming up with the other 20% plus any of the costs for the renovations can easily set you back tens of thousands of dollars. Now, like hard money lending, becoming a money partner, it actually means what you're doing, you're bringing the cash for the deal, and then the other party, your partner, they're actually bringing the deal along with them managing the renovation or the operation of the property. But instead of offering them a loan at like a set interest rate, you actually go in and you become an equity partner with them in this deal, and you're going to make a certain percentage of the total profit at the end of the day. So, for example, maybe somebody doing a fix and flip, they acquire a hard money loan to cover 70% of the total cost of the purchase and renovations, but they still need 30%. That's where you can come in. So in exchange for providing the remaining 30% of the funds, you'll get a certain percentage of the profits when the house is renovated and sold. Typically, it's common to split it right down the middle, 50-50. Leading us to number 7, something called wholesaling. Now, wholesaling is basically the process of going out and looking for good deals. You're going to find these good deals, you're going to place them under contract, and then you're going to sell the contracts to another investor for a fee. Now, to be clear, Wholesaling is by far from passive. You're actually acting as the middleman and must be willing to put in the work to find good deals. Now, in these situations, either the house itself is in distress, it needs too much work to sell just through normal channels, or something is going on in the owner's life that they need to sell the property really quickly for cash. Maybe they're facing like a foreclosure, bankruptcy, behind on their taxes, something like that. That's wholesaling. Number 8, you can go out and you can buy a rental property. Now, if you want to be actively involved in real estate, then purchasing homes and renting them out, it's actually a great way to produce extra money, extra monthly cash flow. To do this, you must buy a home that has uh, a combined monthly mortgage payment, home insurance payment, property tax payment lower than the rent the property commands. Okay, so you'll have a profit. Now, there's several ways to do this, from buying in an area that already has high rents to putting a lot of money down so that your mortgage payment is low. Now, there are actually two downsides to directly owning rental property. The first one is it typically requires a lot of upfront money, a lot of cash upfront. So from the down payment to the maintenance required. Now, you should really assess whether your return on investment after you do all this is going to be worth it. Then the second major downside of real estate is dealing with tenants. Who wants to deal with tenants as you're working a full-time job? You got kids, not me. Now, but then if you do go this route, then you're going to need to screen renters, of course, before they move in. And if you're the type to easily give in to people, you have a real soft heart, you may be better off just letting a property management service basically oversee your properties. Either way, there is going to be ongoing work required. Leading us to number 9, real estate syndications. And by far, syndications, as you've probably seen from previous videos, are my favorite real estate investment, as it allows me to be a hands-off investor. Now, these types of deals, this is basically a way multiple investors, they go in, they can pool funds together to purchase an existing property or build one. They provide investment opportunities. These syndicators, they provide investment opportunities to you and I, the passive investor, and it helps us to contribute to help us increase our passive income cash flow. Now, syndications are actually governed by the SEC, the Security and Exchange Commission, and they must file documentation called a private placement memorandum with them, and they have to report to them as well. Now, originally, these types of investment properties were exclusive, again, to the very wealthy, but they're now much more accessible to the accredited investor. So, as I alluded to a little bit earlier, the two main groups are involved are the GP, or the general partner. They're the ones they're active in the deal. They find the deals, they underwrite them, they perform the inspections, they run all the numbers, they arrange the financing. Either they manage the asset or they outsource it to somebody else. They take care of everything about the property, finding it, making sure it's running correctly, everything. All right, that's what they do. The second group, you and I, the limited partner, those are the passive people. Okay, and this group has very limited risk. So what this group does is they offer their capital, their money, in return for a share of the cash flow and the profits from the property. Again, they're not actively involved in managing the property. They simply sit back and collect distributions, basically mailbox money, every quarter during this whole period. And last but not least is something called real estate funds. Now, if you're familiar with investment funds, it's probably likely that you're already familiar with funds like money market funds, mutual funds, and hedge funds. These are actually a pool of capital that's been aggregated on behalf of multiple investors. So, a real estate investment fund is one that is actually exclusively focused on investing in income generating property. Typically, these funds are actually led by this same sponsor, same type of sponsor. They invest the combined capital from the passive investors into properties as one actively managed portfolio. And real estate funds are actually broken down into two categories. You've got the closed end funds and the open end funds. Now, the closed end real estate funds, they they have a manager that actually sets up the they set up and have a predetermined life of the fund, whether it's 5 years, 7 years, 10 years, or whatever. And most of these also are a value add in structure. And the majority of the real estate syndication deals that I'm invested in, they're also in this quote value add class. This is where the sponsor acquires an asset, like an apartment, that basically needs TLC. Many times, they'll update it, whether it be the exterior, the interior. Typically, it's both. They maybe upgrade the fixtures, lighting, flooring, carpeting, countertops, appliances, painting, lighting. If it's outside, parking lots, upgrade the pools, workout area, clubhouse, whatever. Now, these types of funds, the closed-ended funds, these are capital gains. They're capital gains driven, where most of the expected return is actually earned on the end, basically when they sell the property, okay, when they sell the asset versus the income stream. It normally takes, as you can imagine, several months to years to implement this rehab process. Therefore, closed-end funds may deliver actually negative returns in the initial years. Now, it's critical to perform your own due diligence on the sponsor's track record, as these funds are actually contingent on the exclusion of an underlying business plan, just like most syndications are to begin with. And then the last one is open-ended real estate funds. Now, in this type of structure, unlike a closed-end fund, there's actually no termination date. Okay, there's no termination date. Now, because of this, they mainly employ what's called a buy, fix, and hold strategy, as most of the expected return is actually derived from the property's income stream. Now, the main advantage of this fund structure has to do with flexibility. Sponsors can focus on long-term capital appreciation for their investors and aren't focused to actually hurry up and liquidate and sell, the assets. But the need to produce strong recurring cash flow may actually potentially reduce the aggregate income stream, resulting in lower return versus when you compare it to a closed-ended return. Something else to consider is that open-end funds typically have a lower risk profile since immediate cash flow is part of the acquisition process. Okay, so typically these a little bit lower risk profile. I'm seeing in the dental space more and more dental practices are selling out to private equity. There's a lot of medical practices selling out to private equity. So that's great. They're actually getting something for their practice, but it's like, okay, they'll ask me, Jeff, I'm either considering selling a practice or I just sold my practice. I've got this big check. What do I do with it? And this structure right here, especially the open-ended fund, is great because you can put your money in something that you don't have to worry. It's just like a one-off deal with. So let's say you got $1 million. Instead of dumping $1 million into one syndication or two syndications, you can put it into one of these funds that's actually got 4, 6, sometimes 10 or more assets in it. Instead of single syndications, like a single stock, you've got multiple different investments in a fund. All right, it spreads out your risk. But here's the thing, if all of these deals that's what's in the fund, all of these properties, let's say there's 5 properties, all of them have to do well, and we get paid. We're the limited partner. We get paid first. If we get a preferred return, say 7%, well, we're going to get our money first. So if there's 5 properties in one of these funds, 4 of them do great and one of them does not so great, well, we're still going to get our preferred return. But if it doesn't go above that, guess what? The general partner, the sponsor, doesn't get paid. So what I like about the fund structure is it really incentivizes the syndicator not only to just be focused on one property, but all of them that are within that fund. Because if that fund as a whole doesn't perform well, guess what? You get paid and they don't. Now, let's talk about the final thoughts on basically how to invest in real estate. So now you know, from behind me, at least 10 different ways that you can get started investing in real estate. So again, you can choose to invest actively where again, you got to get your hands dirty and you got to deal with tenants. Or you can be like me and you go the passive route. Either way, if you're looking for alternative ways to generate income for retirement, then real estate may be the right choice for you. The best way to decide which one will work best for you is, again, do your own research on each type before you make any type of decisions. And speaking of doing research, here's a very more full, in-depth look into my favorite real estate strategy, the real estate syndication. Right over here, check out this video now.